Hi folks, welcome to the second model of the high probability trade series, all right? And this will be a very blissful video because I thought it wise to bring out the best trade scenarios to my YouTube community, right? So I've been trading for a while, more than 2 years now, and throughout my experience of trading, there are certain trade ideas, certain trade phenomena that I have found out are high probability. And this is like the third video in this series. If you have not watched the previous one, please go and watch them because everything I'm saying is a build up on the previous topic, right? So the senior candle is just a build up on what I've said in the previous two videos, right? Although this is another model, but it does not negate the fact that it's still a continuation of this series, right? So if you want to have a series, just come to my YouTube channel. It's on my playlist. Just come to my playlist. This is my playlist right here. So just come to my playlist. These are my videos. Just come to high probability trade series, and then you can watch them, right? So you have the part one and part two. So this is it. So this is the part one, the introduction, and then this was the model one, the turtle soup, right? So that's being said, let us go on to the topic for today, right? So the model two of this teaching, we're talking about one of the highest probability setups I have found out. Right. In the first video, I said that high probability trades are not trades that are 100% guaranteed, right? You can still make a loss with a high probability trade. That is why risk management is what important. But the fact about high probability trades is that they have a higher odds of panning out. And in the first video, I used a die for an example. I said that if you're given an option, right, in a die, die has 6 places, right, 6 faces, right? Let's assume that this is a die now, right? So, and the probability of you hitting a one, let's assume that this is a die with a one, right? This is a die with a one, right? It has just one side, right? Just one on this side because the die usually has 6 parts, right? Now, the probability of you throwing this die and hitting a one, right? Let's assume this is a one, right? So, the probability of you hitting a one is 1/6. That means there are 6 possible scenarios if you throw this die, right? So there are 6 possible scenarios when you throw this die. So the probability of hitting that is at least the probability of hitting a one is 1/6, right? But when the probability the given outcomes have been changed, they say, okay, if you hit a one or a six, then you have won, right? Now, if you throw that die, the probability of hitting a one or a six is higher than when it was only one, right? And then if they improve the conditions and it's not a one, a three, or a six, now we have you have higher odds now because there's a higher chance of hitting a one, a three, or a six when compared to the previous one, which was a one or a six, or when it was only a one. All right. Hope you're following me. So this is what we call high probability. We're using the die to the better conditions that is given, the higher the probability of you winning from that through, right? That means if you say if you get a 1 3 or 6, you're going to get $1 million, right? So you have higher odds when the conditions are better. So higher probability trades are trades with better conditions, right? They're trades with better conditions, better odds of playing out, right? So rather than going for only one, now we have uh, a better odd, right? So that is what high probability trades simply is. Higher odds of panning out, higher odds of panning out, right? So that being said, we will be going over to charts. Now, when we talk about a smart money institutional calendar, this is one of the highest probability setups I have found out are quality, excuse me, and they pan out more often, right? Now, there are components, or let me start with the definition, right? For me, a smart money IC is simply a candle with intent. And I simply call this a smart money IC, right? Smart money candle is a candle with intent, right? It's candle with intent. That's why I simply see it as a candle with intent. It has what? Intentions, right? There's a reason it's printed and there's a reason it does what it does, right? All right. Okay. So now that being said, we know that some smart money candles smart money ICs are candles with intent. So what is the intention of this candle, right? Since it's a candle with intent, what is the intention of this candle, right? The intent of this candle is to trip in retail traders, right? For the purpose of filling smart money orders. That's what the candle intent is, right? So the intent of the candle is to, um, uh, use, let's say, use retail traders, right? So use retail traders um, to make money. That's the intent. So when smart money gives an IC candle, they are using retail traders to do to make money, right? Retail traders like you and I and all of that, right? So that is the intent of this candle, to use retail traders to make money. So it's a trip in traders that are retail traders that trade all these traditional patterns like the double tops, the flag pattern, the pennants, the channel, all those retail patterns, right? I'm not saying they're not profitable. Yes, I'm not saying they're not profitable, but this smart money uses those things because they know it. Smart money, they know all these things, right? So they know what retail traders are and how they trade, how they think. So they use that to their advantage, right? So it's just like now you knowing um the whole childhood of a particular child, and they are using the childhood, his instincts, his cravings, and all of that to take advantage. So smart money is using the retail techniques to do us to make money off the retail traders, right? So I know that some of you will be like, go to the point. Why are you just talking? But this is the point, right? You cannot understand this thing I'm giving you without understanding the narrative behind it. Every fact, the forex market is all driven by what we call narrative. So if you don't understand the narrative, the chances of you actually making money off what I'm teaching you will be minimal, right? You have to understand the reason behind this, and then you cannot understand it, right? Right. So that being said, so we have understood what a smart money IC candle is. We have understood what the intent is, and then we can now use this to build, right? I'll just keep this at the side so you can just be looking at this so you will remember, right? So now we have known the intent and then what it is and all of that. So now let's assume that you're a trader that trades double tops, right? So market is coming. You saw the market do what? Reject at this point here. So the market will reject it at that point there. What comes to your mind? Double top, right? So you draw a resistance there. Maybe in the time past, market has also respected it in the past, right? So it's maybe some time ago, maybe a few weeks ago, market also rejected around there. So you saw the market touch there first time, and then you do what? You put your sell limits at that point there. So you have your sell limits there, right? Maybe stop loss a bit above that zone, and then expecting that price should do what? Come to that point and then give you what is sell down, right? So that's what you're expecting for the market to do. But now, instead of the market to do as you expected, what did the market do? The market intentionally took you out. So the market intentionally did what? Took you out and then it was still sold. Now, this is what I'm talking about. Now, this market was going to sell in the first place, but what happened? The market, first of all, it took your stops and then did what? Reversed to the downside. So this is the content behind it. Remember that it's a smart money IC is a candle with intent, and the intent is to use retail traders to do what? To make money. So now, when they push price against you, because market is controlled by volume, right? So if the market goes against you at this point here, you have sold, you have bought from them, right? You know that whenever you put in a trade, maybe you click a sell button, all right, automatically that sell button becomes a buy when you are taking at your stop loss or your take profit. That means when you sell a market, you make profit when you buy at a lower price, right? So when you sell and then maybe let's just say you sold your iPhone at $5,000 and then you now bought it at 4,000. You bought another one at 4,000. You have made a gain of 1,000 because you sold at a higher price and bought at a lower price. So whenever you take a trade, you're selling at a higher price with the intent of doing what? Buying at a lower price. So buying is simply when you take your profit. Right? Whenever you exit a trade, you are taking the opposite direction of your trade. That's how you make your profit. So you sell at high, buy low. Or when you're in the buy market, you buy at low price and then sell at a higher price. That is just basically it. So whenever you maybe bought, you are a dealer of iPhone and you bought it at $4,000 and then you eventually price goes higher and you sell it at 5,000, you have made gain. So that is the concept of trading. The let's say the conventional methods or the systems of trading in your local market, it still applies to the forex chart, right? So when you sell at a high price, you're expected to do what? Buy back at lower price to make profit. So when you sell here and price goes against you and you buy at a higher price, at this point, smart money has done was taking your money and you do was make a loss. So your goal is to sell at a lower price, but then smart money forces you to sell at a higher price by doing what? Taking out your stops. So you are not going to, as you don't want to buy something at a higher price. But the trading system works that when your stop loss is hit, you have bought. You don't need to be awakened. You don't need to be aware. You don't even need to support the fact that you have bought. Right? You don't need to approve of it. Once your stop loss gets hit or you blow your account, in case you don't like putting stop loss, you just take out your stop loss and the market just keep going against you. At that point, when you blow your account, you have still bought by force, right? So it's either you buy it by your stop loss, you buy it by your TP, or you buy it by what? Your stop loss being hit, all right? Follow me. So now we've understood that narrative. So when smart money buys against you, they are forcing you to do what? To sell, to buy from them, right? They're forcing you, right? They want to buy this in orders from you, right? So they're forcing you to buy at a high price so they can do what? Sell to you, right? So they want to sell at a high price and then they're supposed to buy at a high price. So what's one thing that they buy here, take out your stop loss and then do was reverse price the other direction. Now we have understood that. So now when this happens, right? First of all, you usually see what a bull candle that does what that takes out stops. Follow me, follow me. This is a very beautiful concept, right? So follow me, please follow me. So now smart money buys at this point here, right? So you see that buy candle that takes out stop loss. This is a this is a smart money institutional candle, right? I told you it's a candle with intent. The candle that does what? Takes out your stops and then reverses price the other way. So you will find this usually. I will show you which at some few minutes on that. So you usually find something like this. You'll find then next now operate is what? A red candle, right? So you're wondering why did price do this? Right? It was going to sell in the first place. Why did they have to take it out? This is what I'm teaching you now. Right? So smart money bought and took price against you, forced your stop loss to be hit, and then it was sold. They planned to sell, but they did not want to sell without making money off the retail traders because the orders are usually very huge, right? So they need someone to take the opposite side of the trade. So they want to sell this market with huge lots, but who will be willing to buy from them at this high price? Nobody. So they have to force you to buy from them at a high price by doing what? Taking price against you. All right. So that is the narrative behind that. So follow me closely. Now, that being said, we have understood the smart money instruction why it is printed, right? So they take out your stop loss and then it was reverse price the other direction, right? So this is also the case for a buy scenario, right? So in a buy market, market comes to that support, and then this one is just the reverse, right? So you see that sell candle, that sell candle that does what? Takes out your stop. And what happens next? You see price what? Reverse against you, right? So you see price what? Reverse against you. So at this point, the smart money has done what? That. So they sold against you, took out your stops, and then it was bought all the way up. So now that is what it looks like in a buy scenario, right? So back to our sell scenario. So now, how do you make money of this? Be able to understand this. How do you make money of it? It's simple. Follow smart money, right? Don't be trying to sell at a resistance. Wait for smart money to do their thing and then you trade in line with them because you make money when you're following the big fish. So you follow the big fish by doing what they are doing, right? So I'll just redo this again. So now you have understood that concept. What is the next thing? How do you trade this? Now let me give you a context. When smart money bought this, maybe let's assume that they bought at this price, right? They bought here at this price at 1,07728, right? And then they sold it. What do you think happened there? When price is down here, when price is down at this point here, what happens? This buy position is in what? Is in drawdown. Why? Because they bought against retail traders, right? But this sell is in what? Profits. So they bought maybe with 5 lots and then sold it with 10 lots because market is moved by volume, right? So this buy order is usually less than the sell order, right? This order is usually less than this one because for this market to go against this order, simply that this one was higher than this one, right? So now market has done what? Sold against, market is now down here. So when the market is down here at this point, this buy position is in what? Drawdown. Why they sell is in what? Profits, right? Follow me. So now what will they do? Because this buy position is in millions of dollars loss. It's in loss that is counting in millions of dollars. It's not just $1 or $10. I'm talking of $15,000, $16,000, those kind of losses, right? So what do you expect? What do you expect? What do you expect? You expect them to do what? They can't close in that loss. They have to do what? Drive price back to where they bought. So they drive price back here and then close their orders. So now when they close their orders, they usually do what? Add more sales, right? So they can close it here and then do what? Add more sales. So what you're looking at for as now, the whole goal of this concept is to do what? Is to catch your sell here, here. You want to be catching yourself when they are closing this position in drawdown, right? But I've taught you turtle soup. Turtle soup gives you the ability to enter the trade even when this candle is printed. But now, let's assume that you don't know the turtle soup, which I taught in the previous video. You want to now catch it when they are closing. Remember, turtle soup gives you the entry when price is still inside there. But this concept gives you an entry when price has come down and is going back to do what? Mitigate this sell, this buy position, right? So that is it. So you are looking at to do what? To enter your sell inside here, inside here. Why? For a buy scenario, it's just the reverse. So for a buy scenario, you're looking at taking your buy when price does what? Come to that candle and took a stop loss. So you're looking at what? Taking your buy here. That is just the reverse. So now your entry is where? Here. At this mitigation candle, when they're closing their set positions, that is where you're looking to do what? Enter your trade here, and then stop loss should be above the candle, and then you take price what? To the new low. That is it. That is the whole idea of this very easy concept. You want to see a buy candle that takes a stop loss, and then you take price down. Sometimes it does not happen only this way. Sometimes you might see price do something like this. I see price, buying. So price can be doing this, doing some kind of let me just, yeah, I'm correct. So you can see price do something like this. This is the second scenario that happens. So you can see price do what? Creating some kind of what? Trend line, right? Or yeah, let me make it this other way. So you can see price doing this in this other way. So market can be trending downwards, give you some kind of trend line. It also happens this way too, right? So this is just why I don't trade retail patterns. So you can see market doing some kind of trend line here, and then you expect price to do what? To reject off that trend line, right? So sometimes it happens this way. So price to do what? Come, right, and take out this trend line and see the what? Reverse. So this is still the same concept. Market taking out what? This trend line and then reversing the downside. So when price comes back to that scan and took out the trend line, it is also what? A sell idea. This is a very high probability trade, all right? So now we have gotten the concept behind this. We can go to real charts, all right? So let's go to real charts quickly. All right, so now we have understood this concept. Can we apply to real charts? I think so. So let's go to real charts, all right? Real charts quickly. Now let's go to the let me go to the let's use GU, right? Let's use GU. Market is closed. This is Sunday. Let me just delete all these tools, right? So now let us see if what I'm teaching is just a story or if this is actually pan out, right? Does it actually pan out, like I said? Let us see. Let us see if this is actually pan out, like I just spoke about, right? And let's see if it pans out. Actually, it actually pans out. So now let's look at this. Now, what happened there? Market was doing what? Market was trading lower. So if you look at this point here, you would find that there was what? A kind of what? Resistance here. So there was a kind of what? Resistance here. Can you see how market was rejecting all this rejection around there? So we have some kind of candles printing at that point, right? So now what happened next? You can see that. Look at what happened there. When this candle opened, I think I might use a replay button to get that point. So at this point here, what the market do? The market did what? It did what? Burst, took out everyone trying to do what? To sell here. And then what happened next? Price did what? Went to what? The downside, right? Bam, bam. So you can see there was what? A liquidity grab here, and then what? A break of structure, right? So that is it. So now what happened next? After this printed, did you now do what? You mark that place where the candle printed. So you can go to maybe, let's say, the 21-hour time frame, right? The 21-hour time frame. So you can see the exact candle that took our stop loss, right? So now which candle was that? I think it was this one. Right. So you can just mark out that candle. This is that candle that took our stop loss. This was it. So you can mark it into the future and wait for price to do what? Come back there and then you take your sales. Right? Right. So now when I printed, what happened is we expected price to do what? Come back there. So you can wait for price to do what? Come back there. Remember, it's a daily time frame and it's a very good peak at bend. So when price came there, this was it. The markets come back there. So markets came to that candle, they took out what? Stop loss, and it was broke the downside. So when this candle printed, what happened is you saw this heavy sell, meaning that someone actually bought here, took out stock, and then it was sold heavily. So this buy was in drawdown, and then what happened? The price come back there, yes, and the price you can see it actually sold. So it sold and did what? It did what? It formed a new low. Bam. That is just it. This is just the whole thing I've been explaining, right? The whole concept in hindsight. So now markets came to that point and did what? Bam. Did what? Take price what? To the lower, to the low. So that is what a smart money IC is for you. As simple as that. It's not too complicated, is it? I don't think so. So now, when the market comes here, what do? Do you just enter sell? No, you wait for lower time frame confirmation. So this video, I'm not going to be showing lower time frame confirmation because it's going to really take my time, and that's not the aim of this video, right? So let me just check the 30 minutes if I can find quickly. Just maybe for this particular example, let's see if I can find a lower time frame confirmation very quickly. All right, let me see if I can find one. All right, so this is I can find one here. Okay, yeah, there was. I think was there a lower time confirmation? Okay. Equal highs, high, low. Okay. I think this was it. So market, I think market took out all these lows. So I think this was it. Market took out this low and then came back to the what to fill this imbalance, right? So it's a kind of fair value gap inside of these points, right? So there's kind of imbalance here. Right. So I'm not here to talk about them. So there was an imbalance. So the market played off this imbalance, right? So this was the reason market sold up here. So we had a market break this low, failed to make it. This is a failure swing. Market could not make a new high. It broke this low and then came for what this imbalance, right? So this was the entry imbalance. If you are playing this, your random spade was stop loss above that high. That is it. Very how many pips would that have been? That would have been a very beautiful trade. This is a daily time frame trade. You have taken yourself around there. Stop loss above that high because of the imbalance. So stop loss above that high. Stop loss above the high. Right. So these are really like a 20 pip stop loss, and you would have made a whooping 1:, how many did they give at that low? 1:9. Right, beautiful trade, right? I'm not here to discuss lower time frame entry. I'm not showing you the Shina candles, how this things pan out, right? So you have to use whatever confirmation that you use in your mentorship or whosoever taught you, right? So that was it. Bam, price it was went lower. All right. So this is how these things pan out. So now let's look at the components. So now we have understood that there are things that you look at for to make this high probability. So the checklist for a smart money institutional account. Number one, you want to see the higher time frame structure, right? So you don't just trade in ICUC. So you want to see the higher time frame structure and bias. So as if I'm between higher structure and bias, you might want to watch my video on daily bias for that, right? I won't be going to that. Second thing, you want to identify the trading range. Right? You want to be sure that the market is currently in a bearish range or in a bullish range. And you want to find the market at a discount level above 50%, right? Below 50%, right? You just use your fib 2 and draw. What do I mean? You bring out your Fibonacci 2. You want to make sure that price is at 50% before you take your trade. So if you draw your fib 2 from here to here, market was it above 50%? Yep, so it was 50%. You want to see market trading above 50% for a buy, for a sell, sorry. Sorry. and then below 50% for a buy. So you're looking out for market to be in below 50% on your range, right? So you want to see market give you that bearish range, meaning that lower high, lower low. You want to see market in a bearish range, and then after that prints out, this is the checklist for IC. So higher level structure, trading range, and then the next one to see, you want to see a price that was discount or premium level. It has to be above or below 50%. Above 50%. That is also what's meant by discount or premium, right? So you want to see price above 50% for sales, and then the reverse for buy. So the vice versa for buy. So you have to be above 50% for sales and then below 50% for what? For buys. Right? So eyes each side for Fibonacci retracement. Then after that, what do you want to see again? You want to see the final thing. You want to see presence of an imbalance. But you want to see imbalance present. It's not all the time it happens, but you want to see imbalance. It's more of a high probability to. But you want to see an imbalance present there at that point of interest. And then the final thing you want to see in this market, you want to see what we call the lower time frame confirmation. So you want to see that lower time frame, right, confirmation. So you can just play around these things I'm giving you for free on this YouTube channel, right? So you want to see the lower time frame confirmation, right? So this is the final part. So I won't be teaching lower time confirmation. You can join my mentorship program. We have about 4 confirmations we use. I just 31 of them using imbalances, right? So you can write for, you have to see these things for more, right? You can write it out, take a screenshot of all these things, right? And then you can trade in line with this, right? So this is it. This is just what you want to be seen for this, right? So, bam. So was there an imbalance inside there? Let's take out all this. So you can see there was an imbalance here. Was there an imbalance? So take price back all the way here. So was that an imbalance? So let's look closely. Was that an imbalance? Right? So let's check it out. All the source an imbalance validating that setup, right? That's all it is, just an imbalance validating it. Was that an imbalance? I think there was. So there was an imbalance inside of here. So see the imbalance, never just between this week. So there was an imbalance here. So imbalance was very present. You can see clearly imbalance was around there. So this validated was the setup. So imbalance being present. You must not take enter the imbalance, right? Right. This was very clear. So this was a candle. So this was a dark candle. So very beautiful. This was that candle that took us stop loss. That was a smart money institutional candle, and then price came back then does give you a entry, right? So that is it, right? So let's go back to the data. Let's see if we can see just one last example and then we call it a day, right? So that was one of it. Let's see if we can see for a buy, right? Let's see if we can see one for a buy and then we call it a day, right? But I can also look carefully to see if I can find that. I can find us one for a buy. If I don't see that, then you might just need to go and check these things out on your own, right? I can see one example here, right? So look at this. So this is the last example. So just take price all the way here, right? Yeah. So look at what happened there. So what happened there? Anyone trying to do what to sell here would have been clapped, right? So we had a kind of liquidity run at this point here. So we had a liquidity run here. This supports. They will look at this as support because it's saw what price rejected the first. So look at this as support. So people would have also been taken out here. So we saw 2 runs. So see, anyone was trying to buy here, we have been taken out. Anyone trying to buy here, we have also taken out. And where was that corporate? This was the candle, the corporate candle. This was the candle took out. I did that. Took out stop loss. So we have what a smart money institutional candle. So the price come back there. Let's see. So the price come back to that candle to mitigate the sell position. Sometimes it takes a while. All right. So there. Just go to the future. All right. So we have to be very careful with that. All right. Right. So let us go back there. All right, so let's be quick. All right, this video don't be so long. The price come back there. All right, let's just look carefully. All right, right. Price did not actually come back there. Maybe this was where the candle actually started. Right, somewhere around this higher way. And the market candle not really come back there per se. They didn't really come back. Right, so this was one of those examples where it did not pan out as we would have anticipated, right? But I can see another one here. See another one pan out here. Uh, just quickly. So we saw what a kind of resistance forming around there. And some people have been trying to short this market inside this point here. And what happened? market was there, went lower, did what, gave that break construction by doing what, going below what, this swing low, right? So this swing low was taken as a break of structure. So the market was now bearish. So we had, let us see, they sold. We had what, do you have an imbalance there? We had imbalance inside there. So imbalance present inside there. Another imbalance there. Then the price come back there. The price there sold off, and that would have been a short sell, and then so that was it. So although it not hold so long, but this is a daily time frame, folks. This is a daily time frame. Yeah, made a new low. So imagine you call the sell here, you would have made how many pips would they have made from this sell down up here down to this point? This would have been about 300 and 300 and what 58 pips or thereabouts, right? So that's actually a lot of money because it's a daily time frame, right? So we want to see the same panels on the bigger time frame. Let us look at just one. So let's look at USD share. See if we can find another example just the last one, and then we end the call, right? So let's look at this quickly. All right, amazing. It's an amazing call. All right, bam, bam, bam. Right. Now look at this, very easy. So we saw what this low captured by this candle, right? So look at this carefully. So this low captured by this candle. So you can see it's clearly captured by this candle, right? So you can see this low. Right, so people have been trying to buy off that point, right? I think even the year was also captured. Let's draw a line. Yeah, it was captured. So all these lows were captured by that candle. We had all that smart money additional candle. So if you highlight that candle, this was a dark candle, right? So highlight from the open of the candle to the low. So the price come back there. Market it was broke the upside, and then it was came back there and it was bought massively. So that is it. It's so easy to spot on the charts, right? So this is actually a beautiful trade, right? Markets came back there, they what? So you want to be entering market when it comes back with that smart money institutional candle, right? So that's be the end of this call, right? So if you want to join our mentorship program, it's still ongoing. Do what to use the link in the description. All right, we're having a beautiful call today and all of that, right? I tell you, you cannot do when you're trading alone, right? You need a community, you need a mentor to put you through, right? Not just watching any random video online on YouTube. You will not make progress that way, right? So do want to join our mentorship program. It's just for $58. That is 30,000 Nigerian naira, and believe me, it's worth more than you are paying, right? So see you in the next video. Hope this was helpful. If you love this, subscribe, like, whatever. Just make sure you encourage me. Post some comments. I love to read your comments and all of that, right? So that'll be the end of this video. So until next time.